most asset managers, most advisors, everything are incredibly short vol, or they're leveraged short vol. Our homie Med Favors wrote a great essay on how financial advisors are quadruple levered to the market, and they should really think about having some risk solution in there. But so what do you do when you're in that scenario? We were talking about, like, do you just leverage the shit out of real estate, right? That's your long GDP or long liquidity play, is like, I want highly levered real estate, and then I'm pairing it with my long vol and tail risk. And that's an interesting way of doing it. The other thing, just because I can't help myself, what jumped to my mind, if we can get into privates, is I'd be the #1 landlord in San Francisco if you gave me 10 years. I would buy up all those commercial real estate offices and buildings in San Francisco right now. I'd make a 10-year bet on that, especially if I had this private, broadly diversified portfolio.
I'm going to be spending a lot more time in here with you lot, because I love it in here. I fucking love it!
All right, what's your goal? What's your diversification method?
So I think for me, there's a strong capital preservation goal for sure. My goal would be, if I could broadly get within the range of US large cap, call that Russell 1000, I'd be pretty happy. Recognizing that if you randomly sample the Russell 1000 and build equal weight portfolios and hold it for a decade, you could end up with wildly different performance. So first things I'm thinking about are, what are the unintended bets that I might make? Do I end up taking significantly different style tilts than the market has? Do I end up with wildly different sector and industry tilts? By definition, you're going to. Again, I think I'm going to try in my construction to get towards as sector neutral as I can. And within the sector, I might try to then go industry neutral, right? And again, that's going to be really hard with just 10 names. But if I'm looking in the tech sector, for example, I might not pick 2 names in the same industry. I might pick 2 names that are in a different industry. And then I think I'm going to try to rebalance them with bands like constantly towards where the sectors are drifting to. So for example,
say that.
Yeah. So just as an example, like pre-2008, financials were a massive sector in the US. I'm not trying to keep that constant. Like if post 2008 the sector becomes much smaller, I'm not trying to go back to the original weight that financials were. I'm trying to constantly target where they are now. So I'm trying to remove that unintended bet from my portfolio construction and stay in line with the broad sector weights. And then the goal is to pick the stocks such that I'm not picking anything that would diverge too much from the sector.
We'll clarify that a bit. Unfortunately, both of us have some sort of, I guess, implicit mean reversion bias, which is why we like rebalancing probably over longer time horizons. But clarify that, on the sector weights as they are now or whatever. Let's just take example, tech and energy, right? Energy is at the lowest percentage. So if you went 1/n, equal weighted them, and then you're rebalancing bands, essentially you're scale trading those as they maybe mean revert to much more, 1/n sector weights, or how do you think about that?
Yeah. So you are implicitly, so if you were to equal weight, there's 10 sectors, 10 GIC sectors. If you were to choose one stock in each sector in equal weight, you were implicitly underweight communication services and technology, and you are massively overweight energy and utilities, right?
Right.
And those are very active bets that you're making in your portfolio. And so you are saying, well, hey, Corey, I sort of have this mean reversion bias. That's fine. I'm saying I don't want to take a bias. I don't want to take a bet. I just want to let the market price the sectors as they do. Because what we saw post 2008 is tech grew and grew and grew and grew for a decade. A decade, you could have mean reversion or you could not. Energy was 18% pre 2008 and then fell to 3% of the industry right before 2022. 3% of the market. So those trends can last a very long time. I'm not trying to bet on mean reversion. Look, I have operated an equal sector weight portfolio. It tends to implicitly have a value bias, at least not I would say, how do I want to phrase this? A naive value bias. quants who implement value today often do it in an industry neutral fashion. But if you look at like the, academic book to market, the way that's sorted, you end up with an industry bias. Tech always ends up in growth, that sort of stuff. So equal sector weight ends up with a sort of standard academic value tilt. And that crushed you over the last decade. A little bit of a value and a size tilt. So I'm trying to avoid taking any of those tilts at the sector level if I can avoid it. So I'm going to basically try to always be as in line with the sector weights as I can in the way I'm weighting these stocks. And then maybe the last piece is when I'm picking the stocks, I might try to have like just some sort of value screen. Not I'm trying to pick deep value, but I'm like, within tech, like I don't want to buy super overvalued. Like I might prefer a Microsoft over an Apple if I think Microsoft is more fairly valued, because 10 years is a horizon that you can get that strong value reversion.
Right. Allegedly, right? Is there's
Allegedly.
Still timing luck on that?
I am a believer where value spreads are today being so extreme, it's more likely than not. It doesn't mean it has to happen. I would, if I was placing a bet, I would bet more strongly on that. So probably.
Well, that's what we're saying too, is like, that's where, rebalancing is essentially mean reversion, which is, kind of an implicit mean reversion bias or implicit short volatility bias. And that's where trending can really hurt that. And like you said, if we trend over a decade in any sector, then you kind of get hurt by that. But just to clarify, what look back are you using for your sector weights? A decade, 4 or 5 decades? Because that would
just looking at the current weights.
Current weight. You're going whatever's current.
500 and say whatever is the current weight. That's what I'm going for.
You don't want to look like a longer look back to like see like how off.
No, I don't. No, because I don't want to make an off market bet. To do anything but the current weights is to say the market is wrong as it's currently priced, and you are taking an active bet.
So you would in that scenario, you're saying that the market is forward looking, and that the bet is more likely correct, just on the law of large numbers and Mr. Market.
It's sort of saying I'm just going to assume the market's efficient.
Okay, and
it's not that I believe the market's efficient. I'm just going to say that is I'm already being forced into a weird scenario of just picking 10 stocks. I'm going to try to avoid unintended bets that I don't think I want to take. And the unintended bet I don't want to take is sector weights.
Gotcha. And I mean, if that scenario is sector weight, I'm going to disagree. I'm still going to go my 1 over N.
That's why I asked you the question, because I knew we wouldn't necessarily agree. And by the way, I think if you ask me in 2 weeks, I might have another answer if I talk about this more.
And I'm not gonna fight this one out to the death or make this bet on it, because I'm not saying I'm not sure either one of us to be right, but that's just my implicit bias would go for 1 over N. The other thing is I'm clearly not trying to break your artificial rules and be a boner and be like, oh, I'd buy this ETF or this brother, or one of our friends are like,
Conglomerate was sort of as close as you could get to an ETF, right? Like exactly. In an interesting way. I mean, look, Apple has a market cap that's larger than the entire Russell 2000 right now.
Yeah.
Like it's like you could buy IWM and it has less, broad revenue than Apple. So I don't know. These big mega companies in many ways are such diversified businesses. You could argue they are almost like buying an ETF basket of a bunch of small companies.
Well, that's why I thought it was interesting. Our initial inclination, or at least mine, was just hearing the question for the first time is I went with conglomerates, right? When I'm basically just trying to get broad market exposure, like you're saying, like Russell 1000, Russell 2000 exposure. The other question I have for you, though, especially when you only allow 10 picks, we'll briefly diversify from the rules. Would you buy any crypto projects, any NFT? Would anything be in there?
I'll tell you what my hack to this was going to be. If I was going off stocks, I was like, I'm just going to buy a 10 years zero coupon bond that would guarantee the return of my principal. Then I was just going to buy a 10-year, get someone to price me a 10-year S&P 500 in, call option and try to play that. Yeah. The crypto. So this actually came from this conversation came from a tweet I saw someone who's a crypto NFT art collector. This person said, give yourself 10 years. If you had to buy 10 NFTs today and could not touch or trade them for a decade, what are you buying? And I think there's a real, like, again, I know a ton of people hate NFTs and I don't want to drag NFTs into it. I really think that changing the assumption of whether you have liquidity or not, or whether you can trade something in the interim, changing horizon leads to a really interesting thought experiment. So, like, if you're saying to me, Corey, you got to put 100% of your money in something, am I putting NFTs in there? No. If I have to equally weight it, am I putting crypto in there? No. I'm at most, for me, crypto will be 2-3% of my portfolio. Am I going to waste a valuable slot, 2 or 3% on Bitcoin and Ethereum? That's a tough one. That's when I'm already saying 10 is not granular enough to track the market. That's a tough one for me.
So with the caveat, you can't buy any of the tokens that have like multiple tokens inside it, so you get that broad diversification in crypto.
Yeah,
I think it's interesting. Like, I'd be willing, maybe in this scenario, to go upwards of 5% portfolio if I only have 10 selections. But like, but in that, what I think is much more interesting, and this is like, so I give you that, and you have to go, let's say 3 to 5%, and it's one of your 10 names, but you have to choose between Bitcoin and Ethereum. Which one do you choose?
Ethereum.
You think so?
Not even, no hesitation for me. Ethereum.
Oh man, I was probably 60-40 Bitcoin versus Ethereum, but I think there's great pros and cons to arguments on both sides.
Yeah, I'm sure there's a bunch of people on the Bitcoin side that are upset I said Ethereum, but for me, I just understand the Ethereum argument a lot more than I understand the Bitcoin argument. So for me, I can defend the value of Ethereum a lot more easily. So it's more intuitive for me to buy that. What about you? So you 60-40 towards Bitcoin?
Yeah, maybe even 730. I probably more. This is a weird psychological thing of like Bitcoin being more the OG, and I absolutely hate when people bring
the
up Lindy effects.
The Lindy effects.
And it's just, and it's a question. You're betting on, can Ethereum be like the internet or crypto, right? Can all those and does not another protocol come along and disrupt it in the meantime? So that's why I think the hard part. That's why I think I'm more betting on Bitcoin, the psychology of Bitcoin versus.
That's why I'm not putting 10% of my portfolio in that stuff either, right? Like, all right. So here's another question though. You and I both run asset management firms.
Yeah.
Right. You run a very particular portfolio that is designed to survive in the long run. In theory, you have a large amount of private net worth tied up in that business, and that business, its value is tied directly to the performance of that portfolio in many ways, right? Without going into details, like one of the things I always say is, like, as an asset manager, the long-term goal is that your revenue weighted portfolio. So again, it's not asset weighted, but like if you run multiple products, you want to take into account the revenue you're getting from each product. That revenue weighted portfolio, you want to look like a diversified portfolio, because then it's really hard for you to go out of business. And you're effectively, like, if you look at BlackRock's assets, my guess is BlackRock's revenue weighted portfolio looks like a 60-40, a global 60-40. And so BlackRock probably is collecting, 5-10 bips on a global 60-40 portfolio. That's a damn good business. Now, so again, our businesses are at different places, but assuming, right, you have that portfolio you've built that you are earning a fee on, and you can raise enough assets that it's a stable portfolio, does that change your answer as to what you're going to do with the liquid network that's now tied up for a decade? Are you taking more risk on that, knowing you've got the private net worth that's growing very consistently with this portfolio you've built?
Great question. And while I'm answering, can you check your internet connection? Because apparently it's your connection that keeps kind of like jumping in and out, that's leading to static and everything. But like, I'm just glad it's not me. So that's all I'm gonna say on that. I'm sure you're fine, but like, did you, by the way, use the right browser this time? Just before?
I did. I used the right browser. Listen, I told you we had bad thunderstorms. I'm blaming it on the thunder.
Okay. So this is a great question in the sense that, now we had, our flagship is very broadly diversified, but our original product was a very long vol. right? We were long vol and tail risk. And so I had all these conversations with long vol and tail risk managers, and I was like, we're in a unique position where most asset managers, most advisors, everything are incredibly short vol, or they're leveraged short vol. Our homie Med Favors wrote a great essay on how financial advisors are quadruple levered to the market, and they should really think about having some tail risk solution in there. But so what do you do when you're in that scenario? We were talking about, like, do you just leverage the shit out of real estate, right? That's your long GDP or long liquidity play, is like, I want highly levered real estate, and then I'm pairing it with my long vol and tail risk. And that's an interesting way of doing it. The other thing, just because I can't help myself, what jumped to my mind, if we can get into privates, is I'd be the number one landlord in San Francisco if you gave me 10 years. I would buy up all those commercial real estate offices and buildings in San Francisco right now. I'd make a 10-year bet on that, especially if I had this private, broadly diversified portfolio. Then to your point, like this, I would really need to think this through. Like, if I was allowed to just be in my flagship fund, and then, obviously, like you said, on the private side, you have a lot of your net worth tied up in there. One, yeah, as both would know, we'd rather just bet on ourselves for 10 years. But let's say we had to have this, select these 10 names. This is going to be interesting. I'm probably going like hardcore into like tech, and then anybody doing like any sort of form of like real estate or private PE deals or whatever, because that's not what we don't have exposure to. Like, we have broad exposure to the liquid or listed exchange markets. So I'm going to pair it with much more illiquid things that are much more on that tech side. Even though, I mean, obviously you have very concentrated tech exposure with even the S&P and NASDAQ right now. So it's a really tough question. I would need to spend a lot more time thinking about that. It's like, what would pair well with our broadly diversified, like, flagship product? What do you think about it?
Yeah, I mean, look, I think this answer changes dramatically depending on the stability of your business. Like, if I said, okay, you've got 100 million in your fund versus $1 billion versus 5 billion, my guess is what you're willing to do with that, your current liquid net worth, is very different, because you also are going to have that cash flow element being generated from the private side. That's going to, you could take all your liquid net worth right now, and if you run a $5 billion hedge fund, the amount of revenue you're going to be generating from that, sure, take everything you have now, put it in crypto, because even if it all goes to zero, you're going to be clipping enough coupons over the next decade. Who cares, right? Now, that said, your fund could blow up, so that's another risk you need to account for. But again, I think it comes down to what's the stability of your current business, and how much do you think that's going to dwarf your current liquid net worth? And then you can make some interesting bet sizing choices from there. But yeah, I wanted to start simple, one stock, right? And then 10 stocks, and then sure, let's open it up. Like, what else could you possibly invest in? Are you buying art? I'm probably not.
No.
But real estate, I knew you would go real estate eventually.
Yeah, like if I'm pairing with our portfolio, I'm probably going like Brookfield and other firms like Brookfield, and I'll get broad diversification to real estate plays that way. I don't even need crypto, because we have a tiny bit of crypto exposure. So yeah, I'm actually going like all the privates, and I'm thinking about private real estate and every different even sector of real estate. That's why I can get broad exposure with like a Brookfield. I'd have to think about some of the others and trying to get international diversification there. And then I'm trying to think of what would be a good publicly traded equity on like PE or VC or something like that, where I could get, it's kind of the broad exposure. Do you go ARK? Oh, I can't believe I said that. It's like invoking Beetlejuice.
Yeah. Speaking of REITs, private REITs, I don't know if you just saw, but Phil Bach just launched a new ETF that's supposed to be, he's trying to basically replicate private REITs. So I don't know how he's going to pull this off. I looked at the prospectus briefly, and my apologies to Phil if he hears this, and I do his new fund a disservice. It was just launched a week ago. And by the way, this is not a recommendation for anyone to go buy it. I just thought it was interesting. But what he's doing is he's looking at the public filings of all these private REITs, and he's looking at their sector composition. And then he's going and looking at public REITs as well as mortgage-backed securities to try to replicate the broad sector composition of what the private REITs are buying based upon their public filings. I have no idea whether it'll track or not. I have no idea if there's an edge in doing that versus just buying a broadly diversified REIT. a lot of what I saw him writing about was saying, and look, like it'll have like the real mark to market. I think the whole point for a lot of these people buying private REITs is that it doesn't have mark to market. But I don't know. I wish him luck. Anyone launching a fund, it takes it's not an easy lift. So I wish him the best of luck with it. But I thought it was interesting to see again this idea of like we're seeing a lot more ETFs venture into this world of replication. We saw some stuff come out trying to replicate PE using levered small caps, trying to replicate private REITs now, basically trying to bring everything into a tradable liquid format.
Yeah, and you guys love replication. But you also, when you said REIT, it gave me nervous, like invoking Beetlejuice again, of like the homie Roni Israelov, like absolutely hates REITs, and I was just thinking about like the publicly traded ones and like how he breaks down how terrible they are. But also, I like to point out, like, I don't understand necessarily REITs or any of these kind of commercial real estate investing platforms if you don't get the tax depreciation. Like, all of this stuff is really a tax alpha. And I just think people miss that the most because they just want mailbox money and income, but it's much more importantly a tax alpha. And then to your question about replication or thoughts on that, is the simple heuristic I ever have when people ask me about real estate deals. I'm like, why wouldn't you lever up the 10-year? So what that forces people to do is it makes them, people love real estate because of the leverage. But then what that forces them to do, think about it versus lever in the 10-year is like, what specific knowledge do you have, or the syndicator you want to work with? What specific knowledge do they have in that sector of real estate and that geographic location? And it makes you maybe deep dive more of like managing the manager and then all the subtenants and everything. Is it worth the headache versus just leveraging up the 10-year?
All right, that is going to lead me to a related thought. This is something I was thinking about, I don't know, 2 or 3 days ago, thinking about buying property. And the thing that got in the back of my mind was going the funding rate in mortgages versus the funding rate embedded in bond futures, treasury futures.
Yep.
So the mental game I was sort of playing with myself was going, okay, let's say I wanted to buy $1 million house. And I currently had $1 million in bonds, right? Would I sell $200,000 of those bonds and use it as a down payment for the house and take an $800,000 mortgage and keep the other $800,000 in the treasury bonds? Or should I take $800,000, liquidate the bonds, use that as a down payment on the home, only get a $200,000 mortgage, and then take the $200,000 I have left over and use it as collateral to lever up and get $1 million of treasury futures exposure, right? So I'm basically trying to arb the funding rate here. What's now this? There's huge assumptions, like you just have $1 million sitting aside, but the things that I had to think through started to think through, because I don't think there's necessarily, you can't just rely on the funding rate difference. The taxes, right, as you point out, what's the tax advantage? What is the path dependency risk that you're now taking on by using treasury futures versus a mortgage, right? What sort of optionality is embedded in the mortgage that you don't get with the treasury futures? I don't think it's a simple. I started to go through the exercise because I was on a walk. Probably would have been more fun with Excel, but I'm curious as to how you think about it.
Well, there's a couple things in there, like you said, that are very important. One is like mark to market versus mark to model, right, on your real estate play versus like having the treasuries that are mark to market intraday. The second is, do you know, in this scenario, once you're getting up to that million or above million range, the way the tax code works, and by the way, I'm also not a CPA, is basically, you're only allowed to take mortgage deductions, I believe, up to like 750,000. But if you buy the house, even if it's well into the millions, if you buy the house cash and then 90 days later you get a mortgage on it, you can take your deductions on the full amount of the house. So that's another reason to play it, like where you said maybe even it's a hybrid, or where you bought the house cash, later on you mortgage it. But then, like you're saying, the big problem now is mortgage rates versus the yield on the 10-year. And so then the question is, but I think where you nailed is the optionality of the refinanceability of the mortgage, right? You either lock in a rate now, or you're like, high, but then rates go higher and you're happy because maybe you locked in the 30-year. But when it comes down, we're in the U.S. that we have the optionalities on the homeowner to refinance that mortgage at any time.
But I will also say, I'm not sure the optionality is lost if you, right, if the rate today and you pay, call it 4/5 of the house value and you only take 1/5 of the mortgage, you can always refinance in a way that takes the money out, right? So if mortgages go from 6.5 to 2,
right,
I can go, great, I'm going to suck out a ton of money. Like, I don't need to have the massive mortgage there. I think the optionality exists regardless. I think the thing that scares me is the path dependency on the Treasury side, which is, what if all of a sudden, okay, great, you lock in your mortgage and rates go from, I don't know, 3.5%, 4% to 10%, and you burn through 100% of your collateral on the Treasury side. Now all of a sudden you have, because you were levered up, you've got no exposure over there.
In this scenario, you're basically double levered. If rates go up, you're getting smoked on both sides. Well, I mean, you've locked it in on the real estate side. You paid cash, so you're probably fine. But the value probably is going down.
I was going to say the value of the house
you
is
need some
probably
hedge.
going way down.
Yeah, so you need some sort of hedge in there too, maybe to make all of this work. But it is interesting thinking about the funding differentials and the rates and like how you can negate it. Like you and I have talked about, with futures and that embedded cost and the leverage of the term structure. Well, you're using a highly leveraged instrument where I shouldn't use leverage. You could do highly capital efficient because you only have to post the performance bond, and then the rest you can hold in T-bills. So you're able to negate a lot of that leverage or funding cost depending on how much you're leveraging it up. So that's another way to look at it. So you have to think about that in relation to the mortgage. The other side of that, this was interesting actually. Jared Dillian in his Daily Dirt Nap was talking about how, even on different news channels and everything these days, they're talking about, everybody locked in at the higher rates. Nobody wants to sell their house. And so that's why we're seeing this, what he thinks is a floor plateau in housing prices. But he had an interesting counterintuitive thought is actually if rates come back down, that will open up the liquidity where people think they can actually move. And then that's when we're going to see real estate prices actually get destroyed when rates come down, because now the market will open up.
Well, but the market opens up both directions, both supply and demand. All right. Because all of a sudden people, when they want to move, will be open to selling their home.